Well, Facebook stock, or I should say Meta platform stock, has had a tough time over the past couple of weeks. It's now down 48% from its all-time highs, and it's actually trading at a 14 or a 15 price to earnings ratio, which seems insanely low for a business like Facebook, which for so long has been a growth beast. In today's video, I'm simply going to be breaking down the company with Warren Buffett style value investing to ultimately answer the question, is the stock cheap enough yet? It's fallen 50%, but has it fallen far enough? And on top of that, I also want to highlight some key issues in Meta Platforms' business as to why it might not be a good investment at any price, which might seem crazy, especially from someone who has Meta Platforms in their portfolio, but there's a number of things going on in the background that Meta Platforms doesn't really want you to know about, particularly if you're looking to invest in the company, and I want to talk about those things in today's video. I don't really do videos like this very often anymore, but if you want to see more breakdowns on individual companies, then make sure you let me know by leaving a like on the video. And of course, in this video, I can only fit kind of a tiny summary of the deep analysis that I've done on Facebook since really 2018 when I first invested in the company. But if you want access to my full 3-hour video presentation where I break down all of my analysis from the past 3 years on Facebook, then consider joining our investor community in Learn by Example. Not only will you get access to the Facebook analysis that I've done, but also all of the other analysis I've done. There's over, I think, 120 hours or 130 hours of exclusive content that's available over there. First link down in the description below. Today's video is not going to be a breakdown of the company in detail, but as an overview of what they do, they're essentially the second largest advertising company in the world, and they provide digital advertisement placements primarily on their social media apps, which are Facebook, Instagram. They also own Messenger and WhatsApp, which they don't advertise through. The company generated $118 billion of revenue in 2021, and $115 billion of that came from their family of apps business, which is primarily advertising, but also includes some smaller payments revenue as well. And then the remaining $2 to $3 billion is from their Reality Labs business. Reality Labs is Meta Platforms' augmented and virtual reality business. It currently primarily generates revenue through the sale of hardware, primarily the Oculus Quest. Well, I don't think they call it the Oculus Quest anymore. I think it's called the Meta Quest or something. Oculus was way better. But they also sell other hardware such as their Story smart glasses and the Portal device, whatever the hell that thing is. And the reason why Meta Platforms is going to be spending over $100 billion over the next decade investing in this stuff is because they think it is the next evolution of how we interface with the internet. We came from desktop computers and then to laptops and then maybe to tablets and then to smartphones. And Mark Zuckerberg and Meta Platforms believe that we are going to be going into augmented and virtual reality for how we primarily interface with the internet. Now, I'm going to be quite blunt about this. If you're using Warren Buffett, Charlie Munger style value investing, you are not considering the metaverse Reality Labs business in the analysis process at all. It is complete speculation at this point. We have no idea how big this space will be, what it will look like, and which players will dominate. Even though Facebook, or Meta Platforms, I should say, is in front at the moment, we have no idea how that's going to look in the future. So we need to kind of sweep that aside, assume that they'll make no money on that, and focus on the business that right now exists and actually produces a significant amount of cash flow. Even though Meta Platforms' advertising business is already massive, over $100 billion in annual revenue, there is still a significant opportunity for that to continue expanding over time simply through industry tailwinds. The fact that there is still growth in the overall advertising industry, and then within the advertising industry, there has been a massive shift away from legacy types of media such as television onto digital channels, which can advertise more effectively for those businesses. Dentsu Aegis is a fantastic place to get industry data in this space. They put out a report every single year that goes into massive detail of how the overall advertising market is changing, as well as the specific digital advertising market that Meta Platforms operates within. As recently as 2019, non-digital advertising spend was still bigger than digital. However, fast forward to today, and about 55% of advertising is expected to be done digitally in 2022. And that's not expected to slow down. In fact, by 2024, they project that this will be at 60%. And the interesting thing about how the advertising industry is evolving is not only are businesses moving their budget away from traditional means like television onto digital avenues through Google and Meta platforms, but they're also willing to increase their budgets because when they transition to digital avenues, their ads are more effective and therefore it makes more sense to spend more of the business's dollars to get a return on their advertising spend. So what this means is that not only is the digital advertising space growing because people are moving money over from other means, but the overall advertising industry is growing at a pretty high rate as well because businesses are willing to spend more now that they can get more back on their advertiser dollars. And Meta is pretty well positioned to benefit from this massive increase in industry revenue. Of course, it's one thing for the industry to be expanding, but where are those businesses spending their dollars? Who are they choosing to advertise through? And what determines that is the competitive advantages that the particular business has, in this case, Meta. I don't think I need to go into details about how powerful Meta through Facebook and Instagram and these other social apps, how powerful their networking effect is, through which as more users join, the value of the platform increases and therefore attracts more people on, and how difficult it is for other social apps to compete when other big established apps have these huge networking effects. Why would you go and join a different messaging chat if all of your friends and family are using Facebook Messenger? It's probably going to just be easier if you join the one where everyone is already using it, which means it's kind of checkmate. It's like YouTube. No one's competing against YouTube for video because why would I post a video somewhere where there isn't 1.5 billion people watching every single month? But Meta's business needs an economic fortress on two faces. One is the user base side, where they have that networking effect, but the other side is in their relationship with businesses that advertise, and what that really means is how effective are they at advertising, right? It's one thing to compete on the social app front for having a great app that people want to interact and communicate on, but it's another thing to compete with how effective are dollars spent on advertising on Meta, or let's say Instagram, for example, compared to YouTube. And that's where I think Facebook, or Meta I should say, is running into a little bit more trouble than they have previously. Clearly, Meta platforms and Google are far better at advertising than legacy television advertisements that don't really have any detailed level of targeting in terms of interests and behavior of how people interact on the internet through ad tracking. But of course, it's extremely important that Meta platforms can at least provide equally good advertisements as, say, Google can on Google Search and YouTube, because those two are competing as well. And if Google Search and YouTube are providing much better results for businesses through their advertisement dollars, then businesses are going to spend more money there and less money on Meta platforms. And I think this is where Meta might get into some trouble given some changes that are evolving right now. And I'll talk about those a little bit later in today's video. But before we get to the bad news and spoil the party, there's still a number of things about Meta platforms that are really, really great and that are important when we're analyzing businesses using Buffett Munger style value investing. And one of those key things is it needs to be a business run by a great, honest, and skillful management team. And Facebook really shines here. I know a lot of people don't like Mark Zuckerberg, but when he talks to investors on the conference call, he is extremely transparent about what are the problems that Meta platforms are facing and how they're tackling them. And sometimes that means the stock has been more volatile than other businesses, but it's also very refreshing because you know which problems are going on in the business and how they're trying to fix them. And whether or not you like Mark Zuckerberg or not, he is extremely good at leading a team and investing capital, allocating capital within the business. If you look at the return on invested capital for Meta platforms, it's averaged 23.8% over the past 10 years. And in 2021, it was almost 40%, which is off the charts, especially considering they invested $10 billion into their Reality Labs metaverse business, which is essentially $10 billion they burned betting on this speculative business for the future. So if you add back that $10 billion, their return on those investments that they have in the business is insanely high. And they have a ton of cash just on the balance sheet. So if you remove that cash as well and kind of assume that it's not invested capital, it's just cash that's ready to be deployed, then their return on invested capital is something that every company would just dream of having. And they do it with absolutely zero debt, which is the best thing for an investor. I know that businesses can squeeze a little bit of efficiency out by using debt sometimes, because especially right now with low interest rates, debt is a lot cheaper to use, but it gives you a lot of peace of mind if the business doesn't use debt, because if there is a recession, if there's something that happens in the industry that affects businesses, you know they're going to be okay. And then we get to valuation, which is once we have a business that we deeply understand, we've identified that it has competitive advantages, and it's run by an honest and skillful management team, we can try and figure out what we think we can get back from that business. And for Meta, I approach this from two different angles. One is to make a projection of how many users they'll have and how much revenue they can produce per user, and that gets me to a 10-year revenue figure, and I can work backwards from there. And the other angle I approach it from is to use industry data, so to project how big the industry will be and what market share Meta platforms might be able to carve out of that. I'm not going to go into too much detail of how I came up with my specific growth rates in this video, because that's honestly a 20-minute explanation in of itself. But as I mentioned, if you want to see the full explanation and the full 3 hours of analysis I've done on Facebook, not as advice on how to invest in Facebook, but to help you learn how to value businesses, whether it's Facebook or a different business, then check out that first link down in the description below. Also, one more plug, but this one's free. If you want my free spreadsheet so you can do this kind of analysis yourself, it'll be linked down in the description below. You can download it through my website. But as you can see, the growth rates that I'm using in my models range from 4% per year over the next decade up to 12% per year for the next decade. And that might seem really low. You might think, really? You think on average, maybe 8 to 10% or 12% growth per year out of Facebook. But I didn't approach it from a point of view of what number sounds nice. And I think a lot of people think, yeah, Facebook's been growing at this amount, so 15% sounds nice. That's not the way to go about it. You need to look at the industry data, you need to look at what the business is doing and see what's reasonable based on internal projections from the business. And if you do that, this is where I ended up. And when targeting a 15% return, that gives me a fair value of somewhere between $200 and $300 per share. So therefore a buy price with a 50% margin of safety of somewhere between $100 and $160 per share. However, and this is a big however, we can only rely on valuation projections when a business meets all of the previous requirements, being a business we understand with deep competitive advantages, an economic fortress, and a great management team. And on the economic front, as I spoke about, I think they have deep networking effect advantages on the user front, but on the ad tracking side, when comparing them to Google in terms of their ability to serve ads, that's where I have some doubts, especially given some current developments. You might think that Google or Alphabet and Meta platforms serve ads in a very, very similar way. And in a lot of ways, they are very similar. They both rely on automated bidding systems where businesses essentially compete against other businesses for ad placements and try and get the lowest price based on who they're targeting. So whether it's broad or a really small group of people, what location they're in, what gender they are, what age they are, what interests they have, whatever it is. But there are some differences in how Google and Meta platform target their audiences. Meta platform relies heavily on tracking outside of their application. So they do things such as when you're on your mobile phone, they will be able to track which apps you use and what your behavior is when you search on the internet through, say, Safari or Google Chrome, what websites you're going on and that sort of thing, and use that data to then serve ads that are relevant to you in Instagram and Facebook. And Google does do a significant amount of this type of tracking as well for their ads, but a big part of their business, the biggest part of their business, is Google search, through which the information they use to provide a relevant ad to their audience is given to you by the user, by the audience in the search bar. So if you search for online clothing stores, the ads will be related to specifically what you wrote in that search bar. And this first became an issue for Meta platforms last year when Apple, through iOS, made a significant change, which means that iPhone users now get asked if they want to opt out of this kind of tracking when they're using something like Facebook, which means that when Facebook is serving mobile ads through Instagram and Facebook, they can't use tracking data from you using Safari or web searching on an iPhone or looking at different applications. And just this week, Google announced that they're probably going to roll out some of these changes to Android devices over the next few weeks. So iOS devices is one thing. I know a lot of people in the US use iPhones, but globally speaking, it's a small piece of the market. But Android devices, you add Android devices and iOS devices together, and suddenly you're talking about the entire mobile audience, which is primarily how people consume content now. And on top of all of that, likely the biggest threat to Meta's business is this ongoing battle in the EU about transferring data from users from the EU into the United States. Meta needs to be able to transfer user data from different countries into the United States so they can consolidate that data and use it to provide targeted advertisements. And in 2020, a transfer framework which allowed Meta to do this was invalidated by an EU court. So unless a new transatlantic data transfer framework is adopted soon, which seems unlikely because US privacy laws don't meet EU standards, Meta will unlikely be able to provide Facebook and Instagram to EU users, which is the threat that they're giving. But what they're really probably going to do is leave Facebook and Instagram there, but they will have a far less ability to provide targeted advertisements to them, and that is a big part of their business. A decision as to whether Meta can continue to transfer data out of the EU into the United States will be made likely early this year. So we're going to find out very, very soon what's going to happen with this massive part of Meta's business. And all of these things combined mean there's a lot of uncertainty around how effective Meta's ads will be going forward. If you want to hear me talk more about this topic, I have a ton more that I want to say, but I don't want this video to go on forever. So if you want to hear more about this, make sure you let me know down in the comment section below. Hit subscribe if you want to stay up to date. But otherwise, I hope you guys enjoyed this video, and I'll see you in the next one.